Welcome to this explainer. Today, we're cutting right through the noise to look at what's actually driving the future. Look, while everyone else in the mainstream media is, fighting over NVIDIA and endlessly chasing the exact same 3 AI software chips, the smart money, the real insiders, they're quietly loading the boat on a crisis that 99% of people don't even see coming. We're talking about the red metal crisis. Okay, let's dive into this, because if you think the AI revolution can survive without this one incredibly boring component, well, you're deeply mistaken.
Just listen to this quote for a second. Everybody is looking at the brain. Nobody is looking at the nervous system. I mean, wow, right? This is exactly how the smartest investors are playing the game right now. They're looking completely past the heavily hyped brain of AI software. Instead, they've locked their focus onto the physical infrastructure that makes the whole thing actually breathe. Behind every single AI prompt you type, there's a physical, tangible reality that most of the market is just completely ignoring.
So, that brings us to Section 1, the hidden AI bottleneck.
And this brilliantly illustrates what we're talking about. Think of this as the ultimate shovels in a gold rush scenario. History tells us that during the actual gold rush, it wasn't usually the miners who got rich. It was the people selling the shovels, the pickaxes, and the jeans. While everyone is so fixated on the brain, the AI chips and software dominating our news feeds, the true value lies in the nervous system. On the ground, we have servers, immense cooling units, massive power grids, and fundamentally, the copper. Without this unglamorous, heavy industrial side, the brain literally cannot function at all.
To truly understand why this matters, you have to grasp the sheer, terrifying scale of what we're building. By the year 2035, AI data centers could consume as much power as a major city like Los Angeles. To put that into perspective, these data centers aren't just normal office buildings. They are essentially giant furnaces packed with thousands of GPUs, rows and rows of servers acting as massive electricity monsters. And what do these electricity monsters run on? Copper wiring. Every single cooling system, every grid connection, every mile of cable, it all absolutely demands copper.
Which leads us perfectly into Section 2, the copper deficit.
So the crucial point here is that we aren't just talking about some minor shipping delay. We are looking at a massive structural deficit. The world is currently short about 330 tons of copper. Now, to the untrained eye, that might not sound world-ending, but in the context of tightly wound global supply chains, it creates an immediate, severe sense of urgency. You simply cannot just go out and find more of it tomorrow to plug the gap. There's no quick fix.
And this timeline explains exactly why you can't just flip a switch and get more. Look at the contrast. While AI demand is moving at absolute light speed, copper supply is moving at a snail's pace. Year 1 is just beginning the incredibly arduous process of mine permitting and planning. The absolute earliest possible launch for a new mine, if literally everything goes perfectly, is Year 7. And a typical mine completion that takes a staggering 15 years. You can't just spawn a copper mine like a line of code. If you believe in the unstoppable growth of AI, you absolutely have to believe in the necessity and the extreme scarcity of copper.
All right, moving on to Section 3, the sulfur connection. Now, what's really interesting here is how we go deeper below the iceberg. We're talking about a geopolitical supply chain twist that almost no one in the tech world is talking about. This is the kind of second-order thinking that separates the professionals from the amateurs. A full 33% of the world's sulfur comes from the Middle East, heavily tied to the volatile shipping lanes of the Strait of Hormuz. Now, you might be sitting there wondering, why does an AI investor need to care about sulfur? Well, because extracting copper from raw rock requires massive amounts of sulfuric acid. Let's actually walk through this unexpected domino effect so you can see exactly how fragile this whole system is. Step 1. If Middle East shipping lanes get blocked, suddenly you have Step 2, a global sulfur shortage. Move to Step 3. Less sulfur means less sulfuric acid available to extract copper from the earth. And finally, Step 4. Without that copper, the physical infrastructure of the AI revolution just comes to a screeching halt. A geopolitical bottleneck half-world away can directly stop a billion-dollar data center build right in its tracks. It's crazy, but it's true. Okay, let's get into Section 4, key copper stocks. So, how is the market actually positioning itself for this bottleneck? Let's break down the roster and see how investors are preparing for the inevitable squeeze. First up, we've got Freeport-McMoRan, ticker FCX. These guys are the big dogs. They're the established leaders in the space who control major assets, and they're already up 17.7% year to date. Then we have Southern Copper, SCCO, known for its low-cost dominance. Teck Resources, TECK, is up 22% on a really brilliant strategic pivot away from coal and heavily into the copper growth story. And finally, hey, if you don't want to try and pick individual winners, there's the Copper Miners ETF, COPX. This gives you broad exposure across the whole sector, and it's already up over 11% this year.
Let's actually zoom in on Southern Copper, SCCO, for just a second. I like to call them the Walmart of copper because of their low-cost dominance business model. They are capable of maintaining profitability even when their competitors are getting completely wiped out, simply because their production costs are among the lowest globally. Just think about what happens when those inevitable copper price spikes hit due to the structural shortages we just outlined. Their profit margins are going to expand rapidly, and honestly, they're going to look absolutely beautiful.
Which brings us to our final part, Section 5, Smart Risk Management.
Let's move to this and see how it builds. Because having the right thesis, that's only half the battle. You cannot just press buy buttons blindly just because you understand the macro story. The market does not care how smart your thesis is if your timing is wrong. So here's an unemotional two-step risk management system that builds your defense and keeps you in the game long-term. Step 1, your first caution light flashes at a 10% loss. You don't panic, but you pay close attention. Step 2, if a trade goes against you by 20 to 25%, you cut it off completely. You just let your ego get out of the way. It is mathematically and psychologically so much better to keep 75% of your capital to fight another day than to watch a position die slowly just because you are emotionally tied to it.
As we wrap up this explainer, the core thesis is really simple. You can pause software spending, but you cannot pause the infrastructure once it starts. The tech world is shifting right beneath our feet. This isn't about chasing the next flashy software headline, guys. It's about deeply understanding and owning the foundational physical infrastructure that every future headline will absolutely depend on. That is a much stronger, much more resilient play.
So I want to leave you with this final provocative thought. Really ask yourself, are you just chasing the AI software headlines like everyone else? Or are you quietly owning the physical infrastructure they all depend on? Take a step back, look at the nervous system, and position yourself for the reality of what it actually takes to build the future. Thanks for joining me on this explainer today. Stay focused, stay curious, and I'll catch you on the next one.